You can go and I use them as an example here. I don't mean to say anything, but like the Grant Cardone method, I'm going to get as many doors as possible. I'm going to get 10,000, doors or 10,000 units, and I'm just going to grow this massive, huge portfolio. Well, that may not be everybody's dream to do that. Some people may just want 5 properties. That's it. 5 properties that they can go for that cash flow, and they want to get those paid off. So if that's the case, it goes back to personality and what you're looking for.
All right, guys, here we go now. It is time to unlock more doors to deals. We're real estate investors here. We're real estate agents here, and we all have one thing in common. We believe that we can. We can live the life of our purpose. We can create financial freedom. We can build a better life for those that we love, and we can live the life of our dreams. I don't care if you're trying to do your first deal or your 500th this year. You can get to the next level, and we're here to help. Welcome to Doors to Deals. I'm your host and founder, Jim Manning. Today's episode can be found on doorstodeals.com/048. Thanks for tuning in. Today, drum roll please, we have a good friend of mine, Edward O'Daniel, on the line. Ed is a veteran, and he turned himself into a landlord investor, about 15 plus years ago or so. So he's been doing this a little bit. We dive into all sorts of useful things, from the 5 pillars of property management to the buying criteria, the buy box of how to assess a rental property, shiny object syndrome, you name it. And there's lots of great quality content in here, and I know you're going to enjoy it. So before we get started, here's our review of the week.
This week's review comes to us from R.E. Kell, titled An Honest Look, 5 stars. R.E. Kell writes, I enjoy listening to an honest look at the ups and downs of real estate investing and learning something new every time I tune in. Check this podcast out. These guys really are knowledgeable and know what they're doing with real estate investing. R.E. Kell, thank you for your review. Jim, back to you.
Thanks for the review, R.E. Kell. I really appreciate you. And just a reminder, if you're getting value out of this content, please leave us a review on your podcast player of choice. It helps us get the word out and helps kind of inspire us to keep this thing going. So, all right, no more talk on my end. Let's get started on the interview. Okay, so hey guys, Jim here. Welcome to another Doors to Deals episode. We have Caleb online. He's going to be interviewing Edward O'Daniel with us. I've known Ed for, oh my gosh, probably 10 years now, I think. We've known each other for a while.
That's showing your age right there. I've known Ed for a long time. How about that? So
yeah,
I've known Ed for
really long
now. It's like no. That's showing my age on that one.
Yeah, we've done a few deals together. You manage a couple personal rentals that my wife and I own. Ed manages. He owns stuff for Ryan and I, some of our portfolio as well. Really a wealth of knowledge and just kind of general all around good guy. So I've been excited since you said you'd come on and kind of share some of your wisdom, some of your knowledge. So thanks for coming on, man.
No, I'm pumped. I'm pumped here. I'm always a resource for you guys. Excellent. It's my first time on this show, so it's awesome.
Yeah. Okay. So let's get kind of like cranking just as far as getting going on this. So why don't you tell us a little bit about yourself and your background and kind of let us get to know you a little bit.
Well, sure. Well, Edward O'Daniel, I'm based in the St. Louis, Missouri area, just like Jim and Ryan. I got started in real estate back in 2005, a little bit before then, but actually the first property purchase in 2005, picking up a rental property. I was still a W-2 employee, and we had done a refinance on our property and pulled out a lot of money in cash. My wife and I were trying to figure out what to do with it. So after reading Rich Dad Poor Dad and some other type stuff, hey, let's just invest it in a rental property. Let's start building our rental portfolio. So bought a property, completely bought it wrong. We ended up losing $20,000 on that property over the lifetime of it because, number one, I didn't know what I was doing when I got into it. I was just kind of dumb, hopped in, and that's not good, to have that kind of situation without getting educated first and understanding some of the finances, what you should buy, and understanding some of your numbers. But anyway, 2005 is when I first bought my first rental property here, and I've been managing property ever since. I just really like helping other people. with rental property. I hate seeing people struggle using the same things I went through. When if you're getting started in here and I could sit down with you for a few hours or even over 90 minutes, at a presentation and give you a ton of great information to say, here's the things you need to look for. Here's the things that you need to ask yourself. Here's what you need to look for. Don't do this. That way you kind of take the mystery out of all the things that are going to happen for you. So people aren't so nervous, because what people get nervous about buying rental properties is they don't know what they don't know. They're afraid that something's going to come around and bite them. And the problem is I see a lot of people hopping into rental properties, not doing it correctly, wanting to self-manage because they either don't trust a property manager, don't have a property manager, or maybe they just want to save money and do it themselves, but they really don't know what they're getting in for. They don't know all the stuff that landlords have to go through from a technical perspective, like the systems you have to have in place, to even the compliance of keeping tax records, accurately, and being able to keep people's escrow and security deposits amount. And how do you do that? To even understanding the legal perspective, things like fair housing law. So if you're in the real estate market and your agents, fair housing law is always coming up. But for landlords, if you're buying a rental property, you have to really understand fair housing. There's a whole legal side of that you don't want to violate because you're going to get sued. Well, the problem with that is that I try to educate people, which is why I created the veteranlandlord.com and the free training course I have out there, just to help people understand these are the things that you're going to need to go through if you want to be a landlord. And if you don't want to do these things, if there's anything in here that you say, no, I don't want to do, then I'm saying, no, you shouldn't be a landlord, because you're going to need to understand all of these.
What would you say some of the top things are that most people don't realize that you have to do to be a landlord?
Well, that's kind of a bigger question. A couple of things. I have actually 5 bullet points, and I typically call them the 5 pillars of property management. There are 5 main points that you need to go over if you're being a landlord or if you're managing property. And that's going to be, I'm going to say, and we're going to go into details a little bit here in just a minute, but one of them is going to be marketing. One of them is going to be leasing. One of them is going to be maintenance. One is going to be financial or accounting. And the last one's going to be legal. So you're going to need to know all of that. If you're a landlord, you need to know how to market your property and how to put it out in front of as many people as you can, as quickly as you can. What you should say, this is where the legal comes into a little bit. You need to make sure what not to put in your marketing. Because if you have certain things in your marketing, it could be classified as steering, or even classified as you're trying to swing people or isolate people and violating the fair housing law. So that's something that you need to know how to do, and you need to have a system involved with marketing. How do you get properties out? So all of these things that we're talking about either require systems that are low to zero cost. For instance, in marketing, a lot of people don't realize if you want to put your property and post it online, Zillow is honestly a great place to get started. But last year, Zillow started charging landlords. It's no longer free to post a property. So if you're going to be posting a property, then you need to know that you have to go create an account, and you're paying $10 per property per week. At least the last time I checked with Zillow, and that's an expense. So you have to understand that marketing is going to come with the cost. And you're going to have to pay as long as your property is vacant to get those leads. And now who's going to handle the incoming emails? Who's going to handle the phone calls that come in from your marketing? You see what I mean? That's a whole other system that you have to look at setting up. But that's just the marketing side. Once you do that, now you have to deal with the leasing side. So once you get somebody interested, scheduling time to go show your unit, having frustrations where people don't show up on the scheduled time, or if you want to do more of they've got self-showing solutions out there now that are becoming affordable. But for a person with 1 or 2 rentals, that could be kind of pricey to have a $100 a month service that you utilize for that. I mean, that could be outside of their budget. But you start adding up, what are the costs of my marketing? What's the cost of my leasing? What's the cost of all this other stuff? And you have a machine, right? You have a machine that you have to keep going. But leasing, you're also dealing with leases. So now you have to get involved with determining a lease, having that looked at by your attorney. Any of the amendments and addendums that you use with that. Do you see what I'm saying? You're really kind of getting into.
Right. So let's go into like a story here. So, so the first property that you bought, you lost 10 to 20K on. So tell us more on the nuances on that, and how maybe what you screwed up on the 5 pillars, like what
Okay.
am I doing wrong?
Well, the first thing, it's this would be more or less in just the analysis of it. The analysis before you even get into the 5 pillars. 5 pillars is kind of when you own it and when you actually want to get going on it. There's other things that landlords need to do, or even as an investor, that you need to sit back and analyze a rental property. Now, bigger pockets, and there's a lot of other people out there that have rental property Excel spreadsheets or analyzers. You can pick one. They're all roughly similar in what they do. But the biggest thing is I like to always introduce people to something called the 1% rule. So it's a general guideline. It's by no means an accurate, diehard way of determining a rental property. But typically what it says is that if you're buying a property at a certain price, it should rent for roughly 1% of your purchase price. And if it doesn't, you need to look at that. So I didn't know that when I first looked at buying a property. We bought, that first one was around $150,000 and it only rented for about $1,000 a month. So if I would have known that, then I would have known something was off. So that right there, those numbers just right off the bat don't work. So your cash flow is not going to be where it needs to be if you're not getting enough rent to at least cover roughly about 1%. So that was my first mistake, Jim.
Yeah. And so just to be clear, so Ed kind of said, hey, there's some nuances there. Like if you're going to go into more of like a really high caliber area, that's like a higher price point, the 1% rule, I would pretty much safe to say across the nation is not going to happen. Mm-hmm. So if your play is long-term appreciation and you want to own in a nicer area and you have maybe you're clearing 200, 300, $400K a year on your job or your income already, and this is more of like a passive thing that you want a good quality real estate in a quality area, 1% rule is going to price you out. You're not actually going to be able to buy any houses that way. But yes, in your more traditional rental areas, the 1% rule can be a really nice rule of thumb for sure.
Well, and that brings up a good point, Jim, over here. Let me kind of break this down and explain this. This is when you're dealing with rental properties, the 1% rule is really focused on if you are a cash flow investor. So what Jim was talking about is there's 4 main benefits of owning rental properties. You have cash flow, you have appreciation, you have depreciation, and then you have mortgage pay down. The renter's paying down that principal balance on your mortgage if you have one every month. So you get all of those benefits. Now, one of the things Jim just mentioned is if you're a cash flow investor, then you want to focus more like on 1% rule. You want to kind of be in that market where it makes sense. However, you can have a market that's highly appreciating. I mean, if you look at the coast in California, you can have properties that appreciate $100,000 a year. So in that case, they might not cash flow. As a matter of fact, you go negative. If you're dealing with having 100, 200,000 K plus job, it might make sense to go negative, even let's just say it crazy, $1,000 a month. Okay. Because let's just say you have it rented and you're covering that, but you're losing $1,000 a month. So at the end of the year, you're paying $12,000 negative. Most people are like, this sucks. What am I paying $12,000 to own a damn rental property for? But what you don't understand is that the appreciation of $100,000 got added. So really you're $88,000 ahead of the game because that appreciation outweighed the amount you had to go negative on that. So there's different type of investors. The people who typically buy that, Jim, like you're saying, they're looking for tax deferment. They're looking for that depreciation and offset of their big income on their job. So again, there's lots of different nuances. I just didn't want to introduce that typically and blow everybody's mind about, oh my God, just all this other stuff, man. That's a lot of stuff to understand. Oh my goodness.
Yeah, but a lot of people listening are probably looking into more of the 1% rule, wanting to make that cash flow so they can build a big, large business. So what percentage of landlords do you think should not actually be landlords and should have a property manager or something like that? How many people should have a property manager? Everyone?
This is kind of hard because it goes back into the personality of the person and what you want for your life. How do you want your life to look? And let me give you an example. You can go and I use them as an example here. I don't mean to say anything, but like the Grant Cardone method, I'm going to get as many doors as possible. I'm going to get 10,000, doors or 10,000 units, and I'm just going to grow this massive, huge portfolio. Well, that may not be everybody's dream to do that. Some people may just want 5 properties. That's it. 5 properties that they can go for that cash flow and they want to get those paid off. So if that's the case, it goes back to personality and what you're looking for. But that person looking for a small number of units and they're just looking to sort of save money and maximize that, then those are the people I would say would make good landlords. But keep in mind, if you're going to become a landlord, it's another job. And I'll just say it like that. Whatever job you've got, your 100, 200K a year job, now you're adding another job that may make you only a couple of $1,000 a year cash flow. If you're looking at, depending on how many units you have, but that's still another job. A job, systems, monthly reoccurring expenses that happen as a result of doing that, and work on your part. So if you don't want to do that, if you don't want to have another job, that's the kind of person that really needs to hire a property manager and just say, I'm looking at this as an investment. When I bought it, this makes sense. On my rental analyzer, I included the cost for vacancy, maintenance, property management, all that good stuff is accounted for. And here's my bottom line cash flow. This will work for me. And I'm looking at it strictly as an investment. So I'm spending my time, instead of this one job for doing a landlord, now my job is to go out and find other properties. So that's the kind of person that really needs to have a property manager on their team. So
if I can add something in here, guys, strategy becomes clear when you know what the end destination is. So we're talking about 1% rule or appreciation, and there's all different ways to do this. The first step is that you need to decide exactly what the goal, what the outcome of your business is, what the outcome of your rental properties are. Because what we said there, whether you do appreciation investing or 1% rule investing, both can be right. It just depends. Do you have a property manager or do you not? Both can be right. But if you have the end goal vision of what the outcome is, hey, I want to own 5 free and clear properties as quickly as possible so I can become financially free and have $15,000 of revenue coming in a month, like clockwork. When you know what that outcome is, then the strategy actually becomes very easy on whether or not do I self-manage or do I have someone else. If I self-manage, and I'm only going to have 5 properties, I don't necessarily need to invest a couple $1,000s a year in property management software. I could probably do what I need in a spreadsheet. Like all the systems you develop, every other decision becomes clear on the best way to do it when you have that outcome, that end goal for what your business is. And what's crazy about this is a lot of newer people say, well, how do I know that? I don't know like what I want. Well, if you were going to go on a vacation, what's the first step to that vacation? It's, is it a family trip? Is it a bachelor party? Is it a ski trip that you want to do with some buddies? Is it a golf outing? Like if you plan a vacation and you just try and pick the end destination before you decide what you want to do on that vacation, man, that's a difficult decision to make. Do I go to Denver? Or do I go to Branson, Missouri for some golf? Do I all over the place? But when you get solid on that end destination, like, no, I want a family trip with my kids. That's a beautiful experience that they're going to talk about for the rest of their lives. Oh, okay. Well, we have one choice. Let's go to Disney World. Right. So like even if you don't know how to get there and you don't know what strategy, you don't know 1% rule or whatever, your business has an outcome, like has a goal that you want. And if you skip that step, you're going to get stuck in the mud. You're going to have all sorts of, you're not going to be clear on what the best way to do, what the best strategy is to do, what the best lead gen, what the best property management, all that. And that's all symptoms of not being clear on what your outcome is at the end of the day, what you want for your business. And you can decide that with no real estate knowledge, never watching a YouTube video, never listening to a podcast. You can decide that right here, right now, today.
And knowing your big why. Knowing why you want that outcome, knowing why that is important to you and why that matters. I think a lot of people operate through life never knowing their why. And I think that's a huge thing that you need to find too outside of your outcome, where you want to be. Is why do you want to do that? Why it matters to you. And when you realize that, you just get such clear vision to your destination.
Yeah. And then the how becomes easy. It's like the part we think about the most. And yet it's the easiest part when you get clear on what you need to where you need to go. Ed, I apologize, man. You triggered me. I was like, oh gosh, I just did a soapbox moment there.
No, and the stuff that you're talking about, what Caleb and you just said, that's what I did not have in 2005 when I got started. You didn't have a vision, didn't really know what it was, just kind of winging it. And this is one of those things that just scares the crap out of me now that I think about it. Like, how can I even be that way? Or how could I have been that kind of person? But that's why I just try to help other people. Think about it. Think about what you're doing. Is it, hey, I want $5,000 extra money coming in. Great. That's your goal. If that's your goal to offset or to do something or to help pay for college education, I don't know. Maybe you want to have a brand new car. You want to get the top of the line car every year, and you want your rental properties to pay for your auto payments. I don't know. Whatever that goal is, that's what you're setting up.
And think about the difference that a mentor, the different advice you would get if you go to a mentor and you say, hey, I want to generate $5,000 passive income versus I want to generate $500,000 a month passive income.
Yes.
I mean, those are completely different. Okay, we're going to talk apartment complexes. We're going to talk raising hundreds of millions of dollars. We're going to talk about all sorts of things. For $5,000 a month, like, okay, well, why don't we just, you've saved, you have a couple $100,000 in a retirement account. Mm-hmm. Let's get into a self-directed and let's buy that house, and then boom, you're there. Like with cash, and then you're halfway there already. So this is such an important topic, and it's something that a lot of times people kind of skip over and miss. So let's get back to landlording a little bit on this. So and back to your story.
I just want to finish, just about what to look forward to here. I know we kind of talked about all those 5 things. We talked about the marketing side, leasing, kind of what's involved with it. Next you're becoming maintenance. And Jen, you hit it when you're talking about, okay, let's just say you have 5 houses. How are you handling maintenance while you're gone on a vacation or golf outing? Are you getting phone calls every single day from tenants about stuff? Is that something that you want to handle? Or are you going to have to now hire a call center to take those calls and to route them correctly? And now you have to build a team of all these professionals that can go out and handle a plumbing problem or electrical problem or heating, cooling, or general maintenance. I mean, you got to have all these people on your team that are reliable enough for you to sit back and send them out and get it going. But that's, again, a whole other system to set up maintenance. And then accounting. You're going to have some form of accounting, and you could use Excel. I don't recommend it for accounting, but you can keep track of all your stuff that way. But, we're looking at buying QuickBooks. And what people don't understand is that if you're having rental properties, for the most part, having a rental property, even one, already makes the tax filings more complicated than most people are able to deal with, because most people don't know how to deal with depreciation schedules, how to handle your mortgage and all of your principal and interest payments inside of your QuickBooks. So this is now where you have to hire a CPA to do your taxes. On that, not only do you have to manually enter stuff every month, even if it takes you 30 minutes, but now you have to have your books looked at every year. You have to maintain separate bank accounts for money coming in and security deposit money and things like that to make sure you keep track of that. And then finally, we have the legal aspect. We kind of touched about it with fair housing law. You cannot discriminate against age, religion, sex, national origin, and all those other good things. You can't do that. You've got to make certain reparations for people who are handicapped. You have to allow that modification of your home. How do you deal with animals, service animals, emotional support animals that keep popping up now that, people think that they're equal and they're not. But you're going to need to know all this stuff. You need to be more confident that you understand exactly what your rights are as a landlord regarding this. And that takes training, education, but more importantly, it takes time for you to do all that. Are you really willing to put forth all of the time to do the marketing, to become an expert marketer, to become a leasing agent, to be a maintenance person or a general contractor on most routing people, and then becoming an accountant and sitting back and now having to become a legal aspect or have legal people on your team? Because in that same respect, what if people don't pay rent? You're going to have to eventually deal with them. So now you're going to need an eviction attorney on your team or do it yourself.
So it takes time or surrounding yourself with the right network of people that have the answers. So like a great example of this, and this took me so long to figure out, like I did 0 deals in my first year, 1 deal in my first 18 months because I was too afraid to talk to people. A great example of that is, hey guys, I ran into a situation. You put a Facebook post out to, like we have a Facebook group page where you can post and connect with people like in our network. Hey, I have this situation where there's a blind person that has a support dog. I clearly state in the marketing that no dogs are allowed. Anyone know the rules around this? And then boom, you can have several people comment and post, and you find Ed says, well, no, there's issues there you need to be careful about. So like we don't have to necessarily always have all the answers, but when you have the right people around you, or you have the right property manager, you have the right team in place. Like, it's funny that Ed said that, all the depreciation schedules and everything like that. I've been doing this 13 years. We have millions of dollars of real estate that we own, and I don't know how to do that. So you don't always have to know it. I just have the right accountant that does it for me. That's worthwhile to me because I want to focus on being a real estate investor and not being an accountant. I let my accountant do the accountant elements, right? So don't necessarily, as you hear all of this stuff, these are all, what Ed's saying is valid. There's things that you need to think through, and don't get like so crazy overwhelmed with it. And don't let that cause you to get in action mode. You may just need the right person, or the right network, the right people around you to help take care of all this stuff for you.
So, if somebody's interested in investing in rental property, it's like, well, I might be doing wholesaling and rehabbing, but now I want to start looking at building my passive income in my portfolio. I'm sure you have people in your group like that. You do so many wholesale deals, you start making some good money, or maybe you find that great wholesale deal that you're like, man, this is a nice property. I want to keep this one. I don't want to wholesale this one out. I'm going to sit back and look at how can I do this? Some of the questions that we've talked about here is what you should have already asked yourself. If you want to do it, are you going to do it yourself? In which case you need to have all of those systems that we talked about at least in place to some respect before you even go live with your property. Otherwise, you're always going to be behind the 8 ball, if that makes sense. If you don't want to buy a property, have the heating, or the cooling go out when it's 115 degrees and you have no relationship with an heating cooling person. Now you're calling everybody out of the yellow pages, trying to get somebody over there. You're probably going to pay a lot higher prices, and it's going to take longer for you to do that. And it's going to take your time to sit back and do that versus just picking up the phone, knowing who you're going to call, having them go over there and take care of it, and kind of knowing what your costs are going to be for that. As an example.
So, absolutely. Yeah, go ahead, Gil.
So you had the bad buy, you lost a lot of money on that. When moving forward, looking at buying your next property. So tell us the story on how you bought your second property. How did we, did we buy in the 1% rule? What did we look for? Did we do the work on it?
Hey guys, for those of you that are local to St. Louis, I wanted to make sure you knew about an amazing resource that we have to help do some extra deals. You can email our team at deals@3doors.com. And just so you know, we do deals with other investors all the time. Like, it's been hundreds and hundreds over the years, and we've averaged over 100 deals with other investors per year for over the last 5 years. We can straight up buy the deal if you have a wholesale under contract that you want to sell. If you need funding to finance a flip, or like you're doing a BRRRR strategy, we have funding available for you. If you're trying to wholesale a deal, we're doing JV wholesale deals with other wholesalers that, quite frankly, some of the deals we're putting together for a beginner or an intermediate investor, they'd probably be walking away from because we have systems and processes, and we have buyers in place that are paying top dollar for these properties. So make sure you use this resource. And the best way to get and the easiest way is to just send us an email, deals@3doors.com. All right, back to the episode.
So tell us the story on how you bought your second property. How did we, did we buy in the 1% rule? What did we look for? Did we do the work on it?
Right. So no, I didn't. As a matter of fact, that's why a lot of the properties I got up after that one property here. Purchasing it I purchased it for the too high a cost, because it was too high a cost. I didn't factor in capital improvements that needed to be done. It had an older furnace and an older AC in there that should have been accommodated for. in there. And that's another big mistake, is doing those repairs up front and having all of that back into your total purchase price. So whatever that is, you need to make sure that all of these expenses are in there. I didn't learn that until years later, because I was just so excited. I was at the time, I was just doing what now is people call the Burr method. So at that particular point, I was using a line of credit that I had against my house. I'd go out and buy property, fix it up, get it rent ready, then refinance it back out. Back when they were doing 80% cash out refis, everything's good, right? I can get all this stuff done. I could buy a property in this condition, get it renovated, have it pass, and put a renter in there making money. But some of the things I didn't do is make the capital improvements I should have. Or I took money out of the deal. I'm being honest with you. I took cash out of the deal, and I'm like, yes, not only did I get a house that I got for free, now I'm getting cash flow. Now I've got 20% equity. Now I've got all this other stuff. And then, of course, 08 happened, and all that equity went away. Luckily enough, I still did the right numbers as far as, being able to make cash flow on it. But the problem is, when you don't handle your capital improvements up front, they really hurt your cash flow for years. Just imagine if you don't include that furnace, and that furnace is $3,000, and let's just say you cash flow $300 a month, that one furnace is taking 10 months worth of cash flow out of your pocket to cover for that. And that's if you don't have any other expenses in that 10 months. So really, if you don't do it right from the very beginning, if you don't fix all the maintenance issues and the problems that you're going to have, your cash flow is going to suffer after you buy it. And that hurts. I didn't do that. And that really hurt me.
So real quick, we'll
oh, come on, Jim, you're laughing at me here. What's the deal, man? I'm opening my heart, and you're just stabbing me in the heart.
What you just said there made me feel really old. He goes, back in the day when I was investing before, it's called Burr now, but I was doing it before it was Burr. And I was thinking to myself, I'm like, holy crap. I was doing it before it was called Burr too. It's like, we got these new terms for stuff we were doing.
It's just making me feel like a baby here. I learned about burring on bigger pockets, and I was like, holy cow, this is genius. I'm going to go be a millionaire.
Yeah. And I house hacked before that. There was a term for house hacking too. That's what I did on my first home. But anyway, I digress. So, okay. So what's your process now for when you look at that property and you factor in some of the maintenance to try and really make sure you're monitoring your cash flow? Like what are you doing now to adjust for that?
Sure. I mean, it's most of the rental analyzers now, especially if you pick up some of the, I'll just say the Burr, just call it that method. There are other calculators out there now that you can use for those that will do all those nice calculations for you. But just making sure that your purchase price and all of the maintenance, this is the thing that's key, knowing all the maintenance items that you're going to have a problem with. But as a new landlord, you don't know what those are until you experience them. Things like the furnace. If the furnace is over 10 years old, replace it. Even if it's working fine, you should put a new furnace in there to make sure you don't have any maintenance costs. If the AC needs to be switched out, if the roof needs to be done, if the plumbing stack needs to be fixed out, if you have an older electric box that you think may cost, if it's a fuse box, you might want to look at upgrading the electric, type of thing. But all of those costs get bid for those. And if the purchase price and all of those fix-up costs are still less than what banks will refinance you on ARV, most people go up to 75% ARV at this point, maybe 80 on a refinance. But if you see the value add and get the property cheap enough, all of those things should be less than what, hopefully less than what the refinance cost is. And that means you can truly get the property, all the things inside, plumbing and everything is new. Everything's been checked out. The sewer line has been checked out, or the septic tank has been checked out to make sure that you don't have any problems with it. All these things are huge cash flow sucks, if that makes sense, after the fact. So if you get all that stuff done, there should be very little maintenance that you have to do, but all of that cost should be included in your upfront refinance. You want all of that money in there at the low interest rates that are happening right now, and have all of that as one small payment, and then base your cash flow number on that amount. That's what you should be doing right now. And if those don't work, then either you don't buy it, or sometimes even if you go, let's just say if all those numbers add up to 85% of the ARV, and the bank will only refinance 80, then tough. You got 5% down on the deal. You only get 80% out. So 5% of a $100,000 house is $5,000, just to make those numbers right. So this huge house that you've got equity in, you paid $5,000 in that. Just imagine calculating your return on investment with a $5,000 total amount of money into the deal. You're going to be at a pretty good rate of return. Now, not quite infinite like you would if you got all your money back, but you would have a really good rate of return.
And that's the Burr method in a nutshell. And speaking of that, guys, like the Burr method, just because we were joking about it, the Burr method has been around, I mean, since before I was born, right? Like,
yeah,
it's been, I can't say hundreds of years because I don't actually know that, but like sometimes we get confused because we hear something new like Burr, or like it's got a neat name or whatever. I think astro flipping is another one like that I've heard before. It's like a brand new name for a very old investment vehicle.
Yeah, concept.
There's a lot of craze on subject twos is the new thing that I've heard. Guys, and then was it the 80s or 70s where like literally every single homeowner was selling their house subject to because of the environment of interest rates and the difference between the interest rate that they own the home in and that a buyer could buy the home in. So a lot of times the marketers come up with these good new names, but there's real estate is very much a kind of like a copycat industry. Like you just find investment tools that are proven that work, decide what you want to do, and then just apply them. Like there's not new shiny stuff.
Get good at it though. If you're going to take on something, if you're going to be a wholesaler, be good at wholesaling. Have your system down and be good at that, because once you're good and you've got that system, you can train other people to use that system without you being there. Same way with the landlord. If you want to do I'm sorry, Caleb, go ahead.
All right. I would say be good at one thing before you try and do everything.
Yeah. So, I mean, just like a landlord, if you want to build all these systems that we talked about, you can. And then once you start getting enough properties, you can have somebody manage that for you. You can hire somebody and you're making enough money off what you would be costing for a property manager or something like that. You can have somebody hire them and be there for you. So you can take a vacation without having to worry about that. But all of those systems are already in place for that person to take over and use.
Yeah, no, I'd love that. That's great advice, guys. Like, just find your niche, find your outcome, and focus on it long enough to get good at it. And people sometimes, like I one time had someone in our network, one of our pro members, come up to me and say, Jim, I want to do these 4 things just like you guys are doing. And, like we have an agent team that sells hundreds of houses a year. Mm-hmm. We have an investment company that buys hundreds of houses a year. We have this podcast, and we have this pro members network that we have going on. And we have a rental portfolio. We do creative financing. We do flips. We do wholesale. We do all this stuff. But it's been 13 years of building a business that we've done it. We didn't just do this all overnight. When I started, I was trying to flip one house, and I only did short sales for like the first 2.5 years, and then we added on a brokerage, started working with some agents, and then we kind of focused on that for a couple of years. And then we, while we were still flipping, then we just flipped, we focused on one thing at a time, got the right systems in place, added the right people. But it's an evolution. Like if you're going to compare yourself and you're just starting out, don't look at somebody like that's doing a high volume. Don't look at someone that owns 100 rental units. Compare yourself to them when they started out, like when they own 0, because that's a more accurate comparison, right? So,
well, and I would even caution people, be careful on how fast you grow. I mean, even growth is dangerous at a certain speed, because it's like trying to build a tower of cards, and if you build it too fast, it falls over and it can hurt you. So just grow at a pace you can absorb. Over here, I mean, don't get ahead of yourself, and don't get over leveraged with trying to do 50 deals at one time, and you can really only do 5.
I think too many people try to compare themselves, like kind of what Jim was saying, to people who have been around and doing this forever, and not just people who've been doing it forever, but just trying to compare themselves in general. We are all different. We all have different backgrounds. We all have different skill sets, different strengths. It's really, really important not to compare yourself and say like, well, this person does 20 deals a year. Why do I not? You need to do what your own special ability is to do and what your cap is, and not try to beat yourself up because you don't do 20 deals.
Yeah, there's a saying that
Sorry.
I really like: never compare your insides to someone else's outsides. You know, they're so what's interesting is I was talking to a really seasoned investor that we're going to have on actually in a little bit. Sean Greaves is his name. We're going to have him on here in a few weeks, and and he said, "Hey, well, you know, like how many deals have you done?" And I told him, said, you know, like, "Oh, what was your record year?" "Oh, 588 deals." And then he followed up with, "Well, are you guys actually making money?" And I was like, oh.
That's awesome.
I was like,
people
we
are like,
are.
how can you not make money on 588
yeah,
deals?
Yeah, we are. And it's funny you asked that, because the year we did the most deals, we made less money than when we did 150 less deals. We made more profit.
Mm-hmm.
So like a lot of times this quest for more, this quest for scale, this quest for growing something big, if you're doing more deals and your expenses are going up at the same pace, or you don't have control over your expenses and you're not keeping more, doesn't matter. It's completely a wash. And they, like, in this niche of residential real estate, flipping a lot of houses and things, the scale guys that are doing hundreds of deals, it's a very hard to keep your profit margin intact. I know a lot of high volume players that are not making the money that it feels like and looks like they're making.
Well, I'd like to drop some.
Problem.
This is probably some wisdom that you guys have. It's not how much money you make, it's how much money you keep. So that right there, if you hear people, and I used to do this, have envy when you go to RIA group clubs and hear people, oh, you know, we just did $150 million in revenue last year. Well, that's great. That's revenue. How much did you actually keep in profit on that? You know, and then ask them that. And a lot of people they always confuse revenue and profit. And those are two separate things. How much money you make and how much money you keep are different.
And how much money you save and invest is a whole nother different story too. Because so many people spend every dollar they make. And if they don't invest and they don't buy rental properties in 20 years, they're not going to have near as much money as you guys who save 10, 20% of what you make.
Yeah, and I think guys, like we're talking a lot about the outcome and like the vision for your business, like the vision for your life.
Mm-hmm.
And like what that's meant to also do is to be armor and protect yourself, right? Like, oh, okay, well, I see this other investor doing 300 deals. Wait, well, that's not for me. That's on my not do list because I just want 5.
Yeah.
And rather than get lost in the weeds of like trying all these other things or have other people's visions, other people's opinions, like infiltrate you and kind of impact you and kind of get you lost along the way, like lost on the journey. Like it gives you that clarity and that ability to say no to things.
Well, and just keep this in mind. If you ever want to do all this cool, new, shiny stuff, any new thing you add into your life, something else has to be given up. You just can't keep adding and adding. Your cup is only so full. So if you want to do this new shiny object, what do you currently have in your life are you willing to get rid of in order to put that in place? And is it worth it?
Yeah, this is all like, you know, it's like kind of like the pot calling the kettle black here. Like this is like the entrepreneur's dilemma. I struggle with this, guys, like so much. Like, and it's a good reminder whenever I talk about this, like I'm also talking to myself here to like make sure that I know this and I take this into heart. I take this to heart, right? Because this is one of the hardest things as an entrepreneur to do. There's no question about it. Ed, so you've kind of, how do you kind of combat that? Like how do you stay focused? Like what's worked for you, man?
Really, there's 5 things, and actually, inside here I've got it written on the board. I see you've got a board behind you, little whiteboard. I've got 5 things that are written on my board, and I'm going to look up because I can actually see my board from here. I've got fatherhood, marriage, health, career, family, and friendship. So these are things I keep on my whiteboard every time, and I look at it when I come into my office, and I want to sit back and going, where am I at on fatherhood? When is the last time me and my kids have went out and done stuff? And it just helps keep me balanced. So if I got this new thing, again, I always tell myself, if I want to do this new thing, great. I can go out and do it, but now I have to give up something else. What can I give up, if anything? Because if you're working a W-2 job, that's going to be a big chunk. That's going to be, you can't necessarily give that up right now. That could be your family's main support system. So are you going to give up golfing on the weekends, and instead spend 4 hours studying or learning how to be a landlord? I don't know. Are you going to give up, Little League, or, you don't want to go to your kid's soccer game? Nope, not going to go to that this weekend. I'm going to stay here and study on how to be a landlord so I can help be support my family better. Well, you're going to, if that's what you want to do, life's about choices. You're going to have to make the choice. But a lot of people are like, no, I'm not giving up my soccer game. That's a must, because that's what I have with my kids. That's my relationship. I want to go out there and see them. So if you don't want to give something up, then you can't add something new. And look at what you've got in your life. You have to create balance. As more people focus on one thing, other things lose focus. So if I really focus on my business and so forth, my family may suffer, because now I'm spending so much time on my business that I don't sit back and I don't make family dinner. I may come in late or not even at all, because I still may be out in the field doing something that has a cost with it. Is that cost something that you're willing to pay? Because it ultimately over time, it's going to cost you. So that's the kind of thing I think about in my head every time, Jim, when I'm trying to balance on new things. And again, building systems. Can I pass this off to somebody else? If I'm currently doing this, can I hire somebody or outsource somebody to do what I'm currently doing to free up my time so I can do something new? If I can, great. If I can handle that expense and everything still work out financially, then that's great. If not, then I can't. So that's me.
So 80% of success, guys, is all in between the ears. So we're talking a lot about mindset here and how to approach this thing. And
I'm just curious. I know there's a lot of people on the line. Have we been getting any questions from any of the people? Just about, we've covered, man, holy crap. We bounced around from psychology to landlording to how to be an entrepreneur to other stuff. This has been a terrific call. But does anybody have any questions?
Yeah, is there anything you all are struggling with that we can kind of hit on and kind of give you an experience?
This is your network. You got me. If you kind of if you have a question or anything like that from Caleb, James, or Jim, or me, hop on. Now is the time to ask. You got us live. A replay is not going to kind of give you the same aspect. You don't get to ask that. If you're watching this tomorrow or another day. But I want to make sure people are out there. Just have the opportunity. Don't want to point people out. Just, we're here. This is what Jim and Caleb are here for. It's what they have these calls for, to sit back and support you guys and get questions for you. But if you don't, then that's cool. I just really want, again, I don't mean to harp on it. I really want people to think about rental property investment. I believe everybody should do it. It's a great vehicle. It has lots of benefits that benefit you in the long term, especially if you're working a W-2 job. So if you're working a W-2 job, you can afford, banks will give you money. Banks love giving money to people who make a good W-2 income. So yes, you can buy properties. Can you do the BRRRR method if you're working? That's a good question that I get a lot. And the answer is pretty much going to be no. And I don't mean to bust anybody's bubble, but when you're doing the BRRRR method type stuff, it requires, for the most part, you being the investor to source the property. You have to source it. You just can't buy it from the MLS at that cost and do the BRRRR method on it. Maybe, but it's going to require you to fix up and you to be involved. It won't be like a turnkey property, if that makes sense. So that turnkey is a sort of an already prepped, renovated building that's already rented, and you just buy it as an investment vehicle, and you just pay so much down. So if it's a $100,000 house, you pay $20,000 down of your W-2 money. Now you get $80,000 from a bank to finance it. You start making money. You have a property manager manage it for you, and you just start getting checks every month and bank account statements, and you continue to work at your W-2 job and do that. And you don't have to deal with any of the marketing, leasing, maintenance, legal, and financial accounting. You still have to do accounting for some respect. You're going to have to keep track of your books. But if that's the type of investor you want to be, buy that kind of property.
There's a reason why 90% of all millionaires own investment real estate.
Well, the tax benefits are great too. We do have a question. Bryant asked, have you had a rehab that didn't go according to plan? And what did you do to adjust the outcome, Ed?
Yes, I have a rehab that didn't go as planned. Who hasn't? If I've been in this business long enough, I mean, I'm not trying to be funny, but it's just a matter of, okay, let me pick the one that didn't go as planned. Let me pick an example. But actually, I'll give you a great example here of one that, if you saw my Facebook post, I just posted a check for that one that we closed on. It was a rental property that we had here that I bought in 2006 and renovated it. And it was one of my early mistakes, sir. I'll be completely upfront. This house was in the city. It was actually in the Maryland Heights area, Jim. You sit back and this thing had a septic system still in it. And I missed that. I made the assumption, who the hell's going to have a septic in the city? Everybody has public water and public sewer. But this rehab, that mistake right there added 15 grand to my rehab budget. Because I had to close out the sewer system, the septic system, and then run and connect up a whole new public sewer system. That, of course, when you tied in, was on the other side of the street from where my house is. So you had to pay extra to have somebody go under the street without breaking the street up. So that was one big cost I have. And then, of course, right in 2006 to 2007, when I was finishing stuff up here, what happened to the market? So I barely squeezed the sucker out of a refinance. When I was looking to rehab and flip this particular property, it didn't work out. The market conditions weren't right. Didn't see it coming. Wasn't paying attention to it. So this rehab flip, I actually held it from a rental for 2007 for 14 years. It's been a rental property that finally, now that the market's going, I'm selling that one because I really didn't mean to hold it anyway. But now the market conditions were good enough for me to get top dollar for it. So I sold it, moved on, and now I'm looking to buy things that we talked about earlier. How you reinvent your portfolio smarter. Even if you own a rental property, get rid of the ones that you didn't do right, that are not performing, sell them, and then buy the ones that make sense. Do it right. It's not too late. Just because you own a property doesn't mean you can't get out from it and start again.
How much that mistake that you made, holding on to it for 13 years, how much money did you end up making on that deal?
Well, I mean, the closing check was around 50 grand on it. But I mean, you got rents over the years. I mean, it always rented for 1,000, maybe a little bit more a month over 14 years with taxes. I mean, you probably got another 20 grand, in that. I mean, I'm just throwing out just a rough number, $20,000 worth of profit after you pay your escrow and your taxes, insurance, and all the other stuff that you got. So, overall, say, 70 to 80 grand, sort of in that area over the last 13 to 14 years.
That's not a bad paycheck for a mistake, is it?
It's not, but I mean, it's one of those things that, again, you have one focus in mind. I'm going to rehab this house, turn it around, and then what happens? Oh crap! I guess this would be a great lesson for those people who, for instance, you want to flip a house and you can't get it sold at the right price, and you have to make it into a rental. So again, the good tactic is to have multiple exit strategies. If you're flipping it and you want to rehab it, if you can't rehab it, will your renovations, if you had to sell it to an investor, would the 1% rule make sense? If it's a cash flow investor, would the rents be able to support somebody buying it? Or, could you make money at it? So, but yes, that was that I have made multiple mistakes on this, and I simply do it because I want other people to learn from it. I mean, I've made so many damn mistakes. It's not even, here's the thing, as you get older, Jim, some of your mistakes aren't even embarrassing to you anymore. So you don't even mind telling people, you just don't. It's just like, hey man, I did that too. And don't feel bad. Oh really? You got taken advantage of a contractor. You lost 10 grand on a deal. Well, we could trade horror stories, we could trade that kind of stuff, but how can people right now have a checklist or be smarter than you were back then and teach them how to not make that same mistake? So that's what I love to do.
Yeah. So we do have another question for you. As far as right now with these market conditions, I think economists are predicting a pretty drastic appreciation the next year, next couple of years is the research that I have done. What are your thoughts on buying long-term buy and holds right now in a kind of like a seller's market? What do you think?
I actually I'm smiling because I get asked this question a lot on this one, Jim. And I'm going to say it the same way I answer everybody. Any market is a good time to buy a rental property. You just have to know your numbers. You can't be swayed. You can't, obviously you can't pay what people are asking for in this market, but that doesn't mean that you can't find a deal. Typically it requires that you source your own deals. And when I say source, for the people on the call, I just mean you have to find them. You have to do your own marketing. You have to do your own list building, publishing, whether that be direct mail or Facebook ads or how PPC. You need to get in front of people and be able to see if that deal works for you. Sometimes you can be creative about it, but ultimately in any market, you can find a rental property deal. You just have to look at your numbers. If you want to use the BRRRR method, these are the requirements. Don't give on it. If it doesn't match, move on to the next deal. So I would say, yes, you can buy properties in this particular market. Absolutely. So you just have to look at your numbers, man. That's the biggest thing, best advice I can give anybody. Don't be emotional about, oh, now's the time to buy. Now's the time to buy. I'm going to miss out on this bubble. You're going to, as long as your numbers work out, you can buy them in any market, because it doesn't mean when you buy a property that you always have to get bank financing. What if you can buy property and the seller would finance the property for you? What about that? Oh, well, that's what a lot of people go through is like, oh, well, I didn't know we were talking about that. I thought you meant just going to a bank and getting it financed. But again, we're getting a little bit more into the creative financing area, but there are other ways out there to find rental properties. You just have to get in front of somebody and see what works out for everybody.
Yeah, and if I can add a comment on what Ed said too, guys, like he bought a home, like this blows my mind. This is one of the biggest reasons why I love real estate so much. He bought a home before the biggest recession that real estate caused, by the way, like 100 years. This was like a once in a lifetime potentially recession, and what the real estate prices, what the real estate market did. And he still made, by just holding on to it long enough, he still made 50 to 70, whatever the heck it is, $1,000 on the deal. It was the perfect storm for him to lose his you-know-what on. He just held on to it for a while. This is a great vehicle. It's a great investment vehicle. And I agree with everything Ed said. Like, I don't think timing the market is something that. Yes.
There's deals in every market. There are deals in every market.
Ed got the answer right. No, I don't think, like, anytime I ever, even if on like the stock market, like anytime I ever do any research on solid investing, all the advanced high level people, they don't ever really talk about timing the market and that being something that's that can even really be done. It's really more about solid investing principles, following I call it the buy box, is really what Ed was talking about, is like following your buying criteria, sticking to the numbers logically. And you do that, you're going to be okay. You're going to be okay. Like, Caleb, were you going to say something?
Sorry, I was just saying you can buy in any market. You can buy, and you just have to make sure you pay the right price.
And the only thing I would have to say, Jim, is that the buy box that you talked about, you might need some help in having somebody help define what your buy box is. That would be where your coach or mentor can come into, depending on what you want to do. Here's what the criteria that need to be met in order for you to buy it to meet your end goal. And sometimes people need help on that.
Okay, so we're pretty much at time here. I want to make sure that people listening in can kind of find everything that you're doing in the world. One more time, you mentioned your website. One more time. That's
okay. Just veteranlandlord.com.
Veteranlandlord.com. And you said you had what's your free course about that's on there?
It's just called the Landlord Starter Kit. It just kind of goes over those 5 pillars that we talked about and goes a little bit more in depth about here's all the systems that you would need to do that are relatively either free or very low cost to set up. And once you go through there, if you look at that and says, this blows, I am not doing this, then you should not be a landlord. You should hire a property manager, and that should be your goal. In any property that you do, make sure you account for the property manager expense in your cost for your cash flow analyzer, and make sure that's still within your buy box. If that's the case, and because you're not a landlord, you want to be an investor.
I love that. That's great advice. So, okay, once again, website one more time, veteranlandlord.com.
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 I can show you either way. It'll say, hey, this is great. This is exactly what I needed to build some systems in my business. or this really showed me I do not want to be a landlord. Either way, thank you, Ed.
All right, on. Okay, guys, that's a wrap. Don't forget, if you're out there like Ed was trying to figure this whole thing out, we help people just like you crush your fears and get to the next level. If you want to change your environment. All right, guys, just a reminder, don't forget it. If you are out there like Ed was and trying to figure this whole investing thing out, we help people just like you crush their fears and get to the next level. If you want to change your life, change your environment. And that's a great thing about being a human is we get to choose the environment and who we hang out with. Are you around the right people that can help you grow and reach your potential? If you aren't, check out the great benefits our pro members get on doorstodeals.com. To find everything else on this episode and additional resources, go to doorstodeals.com/048. Again, that's doorstodeals.com/048. Go out, live your purpose, and above all else, go after your dreams. Till next time. Thanks for tuning into this show. For more episodes and resources that will unlock Doors to Deals, check out our website, doorstodeals.com.